they were making Twitter, or X now, remove the video because it had a song in it. To me, that's a dick move because I'm not even monetizing it. Like, I'm literally giving the credit to the author of the song, and I'm a fan of it. And it's just me just doing something with no money. I'm not making money off of that. But I get it. I understand. But the rights holder or the artist was having a lot of those videos taken down. I haven't been on Twitter. I haven't been on X. I haven't even logged in. I don't even know what's going on there. I don't know if the account's still active or not. But I know last year I was telling everybody that they were putting copyrights against me, and they were literally removing the videos. I wasn't deleting trade execution videos. I wasn't trying to hide something. I told everybody to download them. So, but if you have them, or if you have the ones that's still up there, if you look at them, you'll see some of the things I'm talking about here. That's what I'm using when I'm trading. When I'm pyramiding entries, for instance, let's just say that I wanted to sell short when we ran above these highs in here and traded right in there as a bold face bullish candle, selling short right there. That is a turtle soup. Why? Because it's clearing these highs, it's clearing this high, and it's trading into a premium array. And it's been going up since last week. So it's reasonable to anticipate it to do what? Retrace. And challenge what? The consequent encroachment of that wick, because it didn't do it here. So we've pushed and pushed and pushed and pushed and pushed. We had two real high impact news drivers yesterday and today. It's Wednesday, hump day. We're in here reaching for a market level that I gave to you yesterday, and we watched it break down. I would not have been filled on any entry here at all, because I would have had a limit order right at this candle's high plus one tick. That's how I would have used it. And you watch and see me in the live stream here. I'll say, I'm interested. I'm watching this to see if it wants to get up in here. Because I'm not going to execute today. Not yet. I will be executing in front of you. You want to see this stuff being pushed on a button? I'm going to do that because I want my son to see how to enter orders, how to place a stop, when to move the stop. I'm going to be doing all that stuff. I'm not afraid of that stuff, okay? But I'm not going to be doing it as a service, okay? I'm not going to be out here doing a dog and pony show every single day because every time they can hear it has a $5 mentorship is going to duplicate what I'm doing. They're going to literally say what I'm in my charts doing. And anybody that's not watching me in another world, third world nation, they're going to be like, this guy's smart. But all they're doing is parroting off of what I'm doing. So that's why I'll be using the 15-second chart, because even though there's the smallest delay in latency between me doing this live and you getting it, that's the way I'm going to combat that. That's the only way I can combat it, because everybody wants to duplicate and copy everyone that's hot and popular. And this old man still got some spice in this stuff. So everybody that wants to rip somebody off, they're doing it mostly off of me. But you'll see all the entries and stuff. But I have to give you the foundations because it's really meant for my son. And then when I start showing him how to enter the orders, where I put the limit order in, where I place my stop loss, and yes, it's important to use a stop loss, not like put a trade on, hope it moves around, and then put a stop loss on, screenshot it when it's in profit. No. Look at my executions. I'm picking a stop loss, and look how nice they are. Those stop losses have logic behind them, just like I'm explaining all these things in here. They have very specific elements that cannot be explained in a 5-minute sentence or video. There's so many supporting things that have to go along with everything that makes these things work, which is why I tell everybody it's going to be expensive. You want it to be fast and easy, and I wish there was a way to do that. I wish there was a way to do that. But you can see that it's not something that is explained right away in one statement, and you have everything to know about it, and you don't ever need to revisit or even worry about practicing studying it. You now know what an order block is, because guess what? It's the opening price. If it's multiple candles, just find the opening price of the up-close candles. That's the change in the state of delivery. They're going to write a book. They can't trade it. They won't be able to do it. They won't even be able to sit over a live price action and explain to you why it's going to happen. But I'm telling you how to do this stuff so that way, once you learn it and you digest all the information I'm supplying to you, because again, I'm not talking to the guys on Twitter. I'm not talking to the guys on Instagram. I'm not talking to other people on YouTube. I'm talking to my son. So I want him to know everything. I don't want to say to him, I'm going to give you a condensed version and filter out a lot of the essential parts that's really going to make it easier for you when you have adversities trying to use it. You're going to know it like the back of your hand. That's how I teach. I'm teaching my children how to know it like I know it. Everybody out there that has my logo in their shit and trying to sell the idea that they know how to use this information, sometimes they can use it. Sometimes they can't. When they talk about certain subject matter that I know they don't know because I haven't fully taught it, that's what gets on my skin. But that's also the reason why I'm teaching in great lengths, because I'm talking to my children. I want them to know every aspect. That means if you listen to the dialogue of everything I'm saying, I'm giving you what you don't realize is going to be a problem. You don't know yet because the question didn't come up in your development or your testing of it yet. You haven't even messed around with it in live price action. You haven't investigated any of this yet. You're just hearing me talk about certain things. And you think, well, I understand how to do that. No, you don't. You don't know how to do it. You just know what I said. And that's not the same as going out and being able to understand how to read it in the new price action that's going to form. So when I get questions saying, how do I know what fair value gap to use? I'm teaching that to you here today. How do I know how to trade the market maker sell? Can you talk about market maker sell models and buy models? Everything I talk about is part of that, even if I don't even mention it. If I never mention those terms, market maker sell model, market maker buy model, every aspect of what I trade off of is part of either a market maker sell or a market maker buy model. It's always there. But because when I taught that lesson, go into the lectures, okay, they're on the mentorship videos, go in the playlist, go into the 2017 mentorship, and you'll see me talk about market maker buy models and sell models. And I talk about the buy side of the curve. And I talk about the sell side of the curve. Okay? When the buy side of the curve is unfolding, that means it's buy side delivery. That means down closed candles or fair value gaps that get traded down into should spring trampoline push price higher. Once we turn to a point where it should reverse or could reverse, which is in essence a turtle soup environment, turtle soup is a reversal mechanism. This is a change in the state of delivery, turtle soup. And then you have a turtle soup that is an entry mechanism that's part of an existing or unfolding sell or buy program. What does that mean? What does that mean? That means that this is a change in a directional price run that's going to most likely be sustained for a session or day or longer. The turtle soup aspect is that we're taking out the liquidity above this high and all these highs here. So the buy stops that's resting in here for anyone that wants to go short or be short, if it's not there, it's definitely above there. But how far, ICT? Well, that's the reason why you want to have these new week opening gaps and new day opening gaps on your chart. 5 weeks for new week opening gaps, 5 days for new day opening gaps. You are welcome, and I encourage you, if you can organize your chart sufficiently, to do more than that. But as a baseline to start with, you'll see many really, really nice trade setups using that criteria. 5 for end dogs, 5 days for end dogs, basically, and then 5 weeks for new week opening gaps. End logs. It doesn't sound right. End dog sounds cool. It's like, yeah, blood, what's up? End dog, yeah, what's up? It's end dog, give me 5, bro. Yeah, that's cool. End wall kind of sounds like an Ewok. Fucking, something wrong with that guy. Something wrong with him. But the information that it gives you, okay, that information is gold, because the markets are going to do what with them? They're going to act as magnets. So if you have one element of turtle soup that is a change in the state of delivery that causes a directional change that's going to be sustained, okay, that's a reversal pattern. Then you have turtle soups that are entry techniques that are part of an existing price run that's still yet to be completed. Meaning that we can look at all the run from here down to this low here, and anything that sees a short-term high pierced, not just by the wicks, not just by the wicks, the bodies. That's why I'm not teaching Linda Raschke and Larry Connor's turtle soup. This right here is not that pattern either. Go look at it. I'll tell you in a very simplistic way. The book Street Smarts has a pattern. There's two of them. There's Turtle Soup and there's Turtle Soup plus one. And all it is they look for a 20-day high. And if it trades above a 20-day high, they will fade that and go short. And they have a very short profit objective. To me, it's infantile. It really doesn't make any sense. But if for short-term trading, like getting in, getting out, real easy, no-brainer type things, if it's going to fail at a 20-day high or low, and I don't trade this, folks, like I don't trade that pattern. There's got to be something else. But for that book, that's all they had. And then there's 20 days plus one, which is basically the same thing, just one more day. And reverse it. They look at an old 20-day. What's the lowest low in the last 20 days? If it goes below that, they're going to buy that. Well, that's not enough information for me. And just as well as they try to capitalize with the name, which is really clever, they try to capitalize on the low hit strike rate of the turtle traders that Richard Dennis trained, because he used that 20-day breakout system. They would buy 20-day highs, and when it was a long-term trend, it would just keep on going, and they would make their money there. But they had a lot of losing trades that the 20-day high breakout would fail, and it would go back into the range and stop them out. So they had a very, very low strike rate. If my memory serves me right, it was less than 38% accurate. So how many times are you going to stay with a trading system that has that low of a success rate? Chances are you're not. You all think you're going to get 198% and all that shit. That's not going to happen. For your first couple years, you should be tickled to death if you're less than 50% accurate and you're still profitable. That's a huge Olympic win, because most people can't even get that. You can be profitable and have a very low strike rate, but it takes the mindset of understanding that it's about making money. It's about staying solvent. It's about following rules and not blowing the account. But it's so easy to go on tilt and lose sight of what it is you're trying to do, and lose sight of these building blocks, these stepping stones to, okay, well, this is what I'm going to use. And if that one transaction fails, it's okay. I'm going to go back tomorrow and I'm going to wait for these things to be there again, and I'm not risking a lot. So Caleb can do every execution when he starts trading, but he can't risk more than 1%. But with turtle suits that are part of an existing price run, not a change in a direction like we have here, you have turtle suit entry mechanisms for your trades. Well, can you think of one without having to go on to any detail further right at this moment? I want you to think about it for a second. What did you learn from me thus far? Maybe in this mentorship this year, maybe it's in other lectures and things I've had on the YouTube channel, or maybe I taught about it in Twitter space when I was on Twitter. What concept do you think would be one example of a turtle soup that's an entry technique in a trade that a existing trend or momentum or seller buy program is underway with? Can you think about that? What do you think it is? Institutional order for entry drill. Ooh, how about that? We have that in the form of, we have an old high here. See that? Why is this high being utilized anyway? Because it's a fair value gap. Every time I go into a short on a fair value gap, or if I go long on a fair value gap, my mind is I'm trading in an inefficiency with a mechanism of entering with a turtle suit. So I'm buying below an old low. So if I'm, like, for instance, I didn't take this trade, so just for full disclosure. Let's say that I was seeing this at the time, okay? And I want to take a trade, and I want to be a buyer. I'm going to use this candlestick here, the high. Why am I using that? Remember what I was talking about earlier? Look at the wick. It's overlapping inside the top end of that candlestick. That makes that small little, I'm gonna have to zoom in. I know you guys can zoom in on your YouTube, but I want to really get in here and kind of give you the brass tacks to this. Because if I'm going to teach it right. So we have this candlestick run up, and then we have this portion where we opened and traded down. You might look at this and say, well, why don't you have this and this? That's something entirely different. This is a normal run-of-the-mill ICT fair value gap. This is what you get when you watch one video and you think you know everything about it. You don't. Just like when I teach a volume imbalance, okay? If I teach you to use a volume imbalance when there's a fair value gap in formation, that means that there's a separation between one candle body and another candle's body that is inside of the fair value gap. We don't have that here. But what do we have? We have an overlapping of this candle's high. It's all body. And then we open, we trade down. It overlaps this little portion in here. But there's no wick there. You see that? Big telltale sign. What's occurring there? It's flush and one little tap down. So, and I highlight this. I'm highlighting that. You're thinking, I guarantee you, I probably got comments right now, and they're probably going to go in there and delete it now. They use my most recent post on my community post. You're drawing the fair value gap wrong. No, you're not. You don't know what the fuck you're talking about. This is how I would classify this inefficiency. But I have to encapsulate it here because this is a balanced price range between this low and that candle's high. That is a PD array that you've never learned before. It's the first time I'm introducing it. Just like when I introduced the inception of the volume imbalance, when there's a gap, a fair value gap, you have to incorporate that because that's the real range of that inefficiency. This inefficiency here, you have to refer to that as well. Notice it doesn't even get down into that gap below right there where it was like this. There's nothing there. It's just a gap that stayed open. Yeah, wonderful. But that's not the narrative. The narrative is you have a balanced price range here inside of a fair value gap. So that's why the market goes down to that level there and sends it higher. So in case you were watching me earlier explain this, because I was in a rant, you were probably thinking, oh, this doesn't make any sense. No, you don't know all the details. This is why you can't get a 5-minute trainer. You can't get a dollar mentor telling you this stuff. They don't know. They don't know. Okay, I promise you, they don't know. And if you're not learning from me, you're getting watered down bullshit. You're not getting the real details, and it ain't gonna work for you. So extending that over here, that's the range. But if you have this candlestick here for that gap from here to here, see that? That gap is part of the sell program. It's formed as it dropped. So those are going to always be the most important ones. I'm watching that because what I'm watching is I want to see, does it converge and agree with something that's over here that formed as a basis for taking a trade. Okay. Let's say that we did not have this gap again. And say we didn't have this gap and this gap. What over here would be in agreement with this 6 o'clock time? Remember yesterday at 6 p.m., we have to annotate that either with the new day opening gap, if there's a distinction between the 5 p.m. closing price and the 6 p.m. opening price, because there's that 1 hour gap in price and trading. They don't trade between 5 and 6 o'clock. We always annotate that as a new day opening gap. But if the 5 p.m. closing price or selling price is the same as the opening price at 6 p.m., all we do is draw a single line, and you can label it whatever you want. If that's all we had there, and we didn't have the inefficiency in this form of this gap here, and we didn't have that one here, what else would be there? And let's say we didn't have this wick here. Say we didn't have that. What else, if it was retracing up, what else would I lean on? I would use this, obviously, but it could trade through them. Remember, it can spike. It can cause candlesticks like it did here to have wicks. What is it doing? Look to the left. It's part of the buy side of the curve. What do you see? Don't look at my cursor. I'm not putting my cursor on it to give you any help. I want you to try to think about it and tell me what you see. Obviously, I can't see. I can't hear you. But isn't this a wick? See that? So what do you do at wicks like that? Ignore them? Oh, it's a doji ICT. You're reinventing. Bullshit. Come on, Steve Nielsen, guys. That's just Steve Nielsen's the candlestick god, puny god. Here's the halfway point of that wick. That's pretty fucking random, isn't it? It went right to that as well. And even if you didn't have all these other things, if this candlestick went up and stopped short of that, that means I absolutely know with a great deal of confidence that the next candle, when it opens, I want to trade into the body of this candle. And as soon as it does that, that's going to be treated as a bearish order block. Not because it's an up-close candle, but I'm trading it because it's inside of the range of that candlestick. Remember I was telling you many times in rants, many times on Twitter Spaces, I can trade inside of an order block before anybody else would recognize it as an order block, or they want to call it a supply or demand zone. I'm trading inside of the candlestick that will later on be obvious in hindsight to someone else. Oh, that's an order block. But you were entering before the order block. How do you know how to do that, ICT? You're getting all the answers in 2024, baby. All you got to do is show up. Just take some fucking notes. All the information is being disseminated to you. Like a fire hose, okay? Don't complain when it rips your fucking face off. Just be thankful you're getting a drink. That wick, that consequent encroachment, extended on over here. So how many things are you seeing converging right there? Lots. That tells you that this retracement here is going to send price lower. That's why I said I want to see it now go down into, go back and listen to the stream. It's going to be there. I can't change it. We're going to look at it and see if it can reach down to the lower quadrant. And it gravitates from here down to that. Then what does it do? It returns back to the midpoint, consequent encroachment of that wick. See how that works? Boom. Oh, this is classic support range system. No, it's not. It's not supply and demand. It's technical science. Anton Creel. It's technical science, babe. You know he's fucking watching these videos. If someone tells you that they can tell you what's going to happen in intraday charts, run away from them. They're a con man. They can't do it. They're not. Well, what do you do with us? It's a whole bunch of us doing it. Market trades up to that and then trades down to the low and explores below the low, which is what we have here. Okay. Now, with that said, I've exhausted everything to do with the buy side of the curve over here. Then the rest of it is just simply using the rejection block and the actual low. Okay, so we went through all the PV arrays from that high going backwards inside the range. So that's trading inside the range. So my question to you is, out of all those things there, which element is your multiplier? What's the one that you see right now? I'm not saying that you can go out and take a trade with it. It doesn't mean that you can go out there right now in front of the whole world, live stream, and do entries with it. That's not realistic for you to expect that. I wouldn't expect that out of you. But which one did you see? Chances are you didn't see all that. You might have saw one or two, maybe three things. But which one did you easily see without me making special attention to it? Or if you're brand new, out of all the ones I just described, the one that makes most sense to you right now, because that's where you start. That's your beginning point. That's the thing that you look for in price action. And when it's not there, you do nothing. Until you get more understanding and more learning, more experience watching me call this stuff over live price action, then you'll see, oh, I started with a so-and-so PD array, and that was where I first started learning. But then I really fell in love with this particular PD array. I'm leaving it blank so that way it gives you the flexibility and allow your personality, because it's essential for that to be there. I don't want to force you into this is the only way to do it. But Caleb's going to have to learn all these other ones in addition to just simply a fair value gap, because it supports holding on to a trade. ICT, can you talk about how to hold on to a trade? Because I get shaken out of trades, and I have a target, but I get scared and I get taken out of it because I'll close a trade and then it goes to my target. Well, you have to know your range. Up here, well, if it's going to go lower, where's it going to go? To that low is where sell side. But before we go there, we have all kinds of opportunities, which is what I just outlined. We don't need it to go below that low or even trade to that low to be profitable. Any one of these PD arrays that we outlined in the rejection block and that low and in this consequent encroachment on that wick, that could have been a partial, that could have been a terminus for your trade. And guess what? That doesn't mean that you're stupid. It doesn't mean that you're not good at trading because you didn't hold for all this run down here. You have to have a starting point. Like my son, Caleb. He has to have some kind of measurable expected range to operate in at around a specific time of day and do the same things every single day and not worry about what's going on outside the boundaries and parameters that entails, because you're always going to find an excuse to feel like you didn't do enough, you didn't make enough, you didn't get in at the best price. You didn't hold for the best price and get out at the best price. Like that's something that you're going to be plagued with the rest of your life. As someone that's been doing this for 30 plus years, I don't like my exits. I want them to be perfect. I want them to be better than they are. And you see what I do with my executions. When I show them an entry, manage the whole show, you see that. It's pretty good. And if I can go back in time and say that to my younger self at 20-some years old, here's how you're going to know how to trade later on. I'd be like, if I can just do that, I'm happy. But that won't be true when you get to that point, because you're like, I want to go beyond this. So you're always striving, at least for me, I'm always striving for perfection, knowing it's going to evade me, but I'm going in the right direction. I'm not trying to go the other way. I'm trying to refine and make it better. And usually that's done by doing little and less. Not more of the same stuff. It's just doing less of the things that I try to do. And that's when I don't try to beat my own systems. When I don't do that, I have the better exits. And when I try to finesse certain things, because I think I've woke up on a better side of the bed. I think I'm going to really do a stunner today. My exits aren't as fashionable as other times. So I don't know if that means anything to you, but I just learned that that's what I've observed in my own exits and my own strategies and such. But when the market creates this fair value gap, this high right here, okay, let me take this off for now. Let me take all this stuff off for now. And what I'm saying is, conceptually, from this candle's opening price all the way down to here, and we'll just use, we'll replicate. This is also a targeting strategy, so you can write this in your notes too. It'll be in the book in case you don't fully get it here. Because I have a wick, I'm grading that price swing, or that range, if you will. We have a quadrant. So if we have this, and it's 1/4 of that range, I'm going to ballpark another quarter range projection lower. And it's about right there. I'm looking at this here to here. Okay, that's what I'm doing right there. And if I want to, I can do this. That would be negative 0.25. What happened here? I did it wrong. There you go. That's pretty good. That's pretty close for eyeballing it for a 52-year-old without a prescription updated. And my eyeglass, I had my eyeglasses prescription checked, and I discovered that I have gone up 2 prescriptions, and that's the biggest jump I've had with my vision in my whole life. So that's a little disconcerting. But the range here that I just projected, that's a good target right there. So if we're going to go below this low, how can you determine a very low threshold, very easy, low-hanging fruit objective? If you want to try to trade for something lower than that low, how can you do it? Well, what is that low part of? Is it part of a range like this wick, or is it part of the range from this high down to that low? If it's going to go below that for the express purposes of using the wick for your target, or the range high down to that low. If it's going to go below that low for seeking liquidity, okay, let me do this. Okay, we just did the measurement on that anchored right here. We're going to draw this up to that high. And you can see it's on that low. The same aspect of what we were trying to measure for projections. We can do that same thing with that range here. And whatever the 20% or 25% or a quarter of that range here, we can project lower. That's the lowest threshold. That's the easiest. If it's going to go below an old low, how far can it go below the old low? And you can get that measured by that. So you have the low of the actual candle, like this. See that? That's the low. That's where we were targeting. And anything below that would be liquidity. What kind of liquidity? Sell side. And if you're using the range, you're going to be using range targeting. This range is the high to that low. And this is 1/4 of the range projected below that low. And that takes us to this level here. And that's a pretty good target. I mean, you won't get all that, but that's okay. I mean, that's usually like if you're not using standard deviations. Now, standard deviations are taught in the mentorship videos on the 2017 mentorship playlists. I don't recall off the top of my head because I'm 52. I'm having a Biden moment right now when it comes to think about where the content was per month. I don't recall what that was because it's been a little bit of time since then. But where I'm teaching standard deviations, that is the closest thing that I'm going to reveal to the public on how to get really, really, really tight precision grouping with your exits that are closest to the highs and closest to the lows. But if you want something that's very simple, doesn't take a whole lot of work, it's really off the cuff quick, it's just what I just showed you here, okay? And if you just rewind this portion again, it'll make perfect sense to you. The only thing you're doing is trying to get 1/4 of the range beyond the low or high that you're trying to trade for. So this is what we were aiming for. And that's the excuse for reaching for something in here or in here and being content with not getting anything beyond that. And that's going to be a skill set for you to acquire where I made enough money and you have to come to terms with whatever that is. And over time, you're going to see that that is more than plenty, but it won't feel like that when you're first learning. So back to this right here. For turtle soups that are part of an existing price run, anytime you're trading in a fair value gap, you're literally trading a turtle soup. You're trading above and going short an old high, which is this candle's high. So it's not support and resistance that we're trading. We're trading with the express purposes that there's an absence of buyers that's been afforded any opportunity to be a buyer above this candle's high. That's essentially what my fair value gap is doing. So let's do this. Let's amplify this. Again, this is a little reminder. If you guys are learning today, if you like this kind of stuff, because when I don't see a lot of thumbs up and I'm teaching stuff that I never really wanted to teach, it kind of makes me feel like, you know what, I'm gonna slow my roll and I'll just not be so forthcoming with the information because it doesn't cost you anything to do a thumbs up. But I like seeing that because I know if I got 100,000 views on a video and 175,000 views of a lecture, and I see like 10,000 likes or 5,000 likes or 6,000 likes, to me, that's a little insulting because I don't need to be here. I could very easily say, Caleb, fuck these people. I don't like what I'm doing. I don't feel encouraged to do it. It's free and they're not appreciating it. And it's kind of like a FU or a middle finger to ICT when it's like that. That's how I view it because you're not going to get this information from anyone else. They're not going to explain it. They're not going to give you the details. They're not going to give it in a way where you can use it and know how to do it without me ever teaching it to you again. That's how I'm teaching it. There's no catch here, okay? But I understand that it's the mentality of most people today is, you owe it to me. I don't owe a fucking thing to anybody. But a guy leave me a comment saying, hey, when you say fuck you, we have a lot of students that really like you and they might think you're talking to them. In this regard, I am. Because if you're watching my stuff and I'm pouring my attention and time into my son and I'm making it available to you, I know it works. You're watching it unfold live over the charts. There's nobody else doing that. So if the logic is real and it's valid and it repeats over and over again, and I'm telling you the why, that way you learn how to use it, trust it, and then you can anticipate it. How to know how to find it on your own. That's what mentorship is. It's not me out here demonstrating my toys. It's me teaching my son in your witness. So when he's duplicating these types of things, you were there as he learned it, how he learned it. There's no secret lessons. Look, I'm 52. I'm running out of energy here. So I'm pouring everything into this. It's not going to be anything outside of this because I'm pouring hours and hours and I got people complaining. Your videos are too long. Well, then break it up. Nobody says you had to sit down and watch it in one setting. That's the problem. You're trying to rush through it all. But the fair value gap is this. We have one single pass. The shaded area is highlighting this candle to that low, that candle, okay? I don't care about anything else except for that candle's low because there's no volume imbalance there. See that? No volume imbalance. We're part of the sell side of the curve. We're dropping. I want to see it stay low. I want to see it stay low. So I am only interested in technically seeing, I don't really have that highlighted. I'm going to take the 6 o'clock price off. So I got to remember how many steps I do so I can do Control Z, it'll put it back. Meaning this. So if I take it off, and then I'm going to add the midline on this. So that's how you do that. And I'll make it black because I want to make it pop on the chart. So all things being equal, no wick discussion. It's just this fair value gap. What we're talking about is it's part of a sell side delivery. It's part of a sell program. The market's reaching lower for sell side or a discount inefficiency. I took your attention to the midpoint of that 830 gap, which is here. I forgot to change the color. So if it's going to trade up into this inefficiency where only one candle passed, so between this candle's high and that candle's low, it only went down one time in one candle for 1 minute. That's inefficient with buy side. Buy side is where price is offered going up. Buy side liquidity is where it's reaching for while it goes up. See? Buy side liquidity are actual pending orders in the marketplace, either to buy into a new long position or to buy and exit a short position as a stop loss being activated. I'm looking at that high right there, and I want to be a short seller generally on the fair value gap. I'm trying to put my limit order at that price or one tick above it. That's my first 6 contracts. That's my model. And then if it can trade up into the midpoint or as it starts to slide towards it, then I'll throw in my 4 contracts. So what does that give me? It gives me 4 lots. That gives me a total position so far, scaling in 10 contracts. I am not inviting you to trade with 10 contracts. I'm not saying that you have to trade with 10 contracts for it to be profitable. You should only be watching price action, Caleb, and saying, okay, this is where we're eyeballing it and saying, I want to see how it behaves once it trades there. Does it go all the way to the midpoint? Does it go all the way to the top? This is permissible. Remember that term? It's something that is allowed to happen, and it doesn't change the underlying direction or where the market's going to go. It just means that this is possible to happen. It doesn't change anything. It's better, it's much better if it only goes to half or less and then does this, because that means it's really, really weak. But because I already expected to go lower, this is just an opportunity for the market to reprice to that level right there. That candle's low. It doesn't reduce the effectiveness of the trade. It doesn't make it more profitable or less profitable. It just gives me as a emotional and psychological comfort that I am on side. It's going to start really running away quickly after it rolls out of here and doesn't go in the upper half. So meaning this, if it's like this portion, like say it's like that much of the gap, doesn't get traded to, and say this wick only went up to like to here, but left all that shaded area open and not touched that high, and then it did this price action here, that's usually, if you watch my examples, and you'll see me talking about it in real price action when we get through the August content, and then we start looking at minute by minute, second by second candlestick, and then what you're observing, Caleb, what to anticipate, what it should do right now, not the overall grand scheme of how to reprice and where it's going to go and how to behave in those ranges. That's what we're doing right here. This is the beginning point, and it's not a one module lecture. There's a lot of, clearly, as you can see, there's a lot of things that you need to weigh out if you really want to know what price is doing, how to trust that you're going to be a part of a trade and hold on to a trade. I've answered so many questions already in this lecture that have been brought to me over the years constantly. But I want, if I'm shorting a fair value gap, I want to enter at that old candle high. And by the very nature of it, that's a turtle soup. You're going short above that high. You're trading in an area of inefficiency, and you think this is turtle soup. you think it's this. This is dollar mentorship menu memberships where they're trying to teach you this stuff. The Wish version. Why you gotta go there, ICT? Why you gotta start some trouble? You're always trying to bring a ruckus. No, I'm trying to remind these cats that they don't know shit. And they're pretending that they do. And they're hurting people. They're messing up people's expectations and understanding. And they're actually prolonging their learning curve. Because they got to learn that horse shit first and realize that they just watered down something and taught it incorrectly. And they come back to me. And then they're like, oh, man, I wish I would have just started with you. Right. Whatever. You can eat where you want to eat. But you think this is turtle soup. Just a high, pierce above it, and then there it is. But that is true here. That's a breaker. Breakers tend to be turtle soups in changing directional sustained price runs. Where you have high, low, higher high. There's your breaker, but the essence is a turtle soup. That is not what's going on when you're using it as a trade entry that's part of an existing or underlying or unfolding sell program or buy program. Because you're looking at one single candle like this, and you have to get above that candle. Well, how far can it go? See, it's going to be harder for you to do these entries here, because as it's going up like that, you're not going to want to stand in front of that. It takes more experience learning the things I told you this level yesterday. And I know you probably didn't watch the video. Some of you are just looking at this one, or you didn't watch the entire video yesterday. You heard me talk about other things, and you're like, okay, he's done teaching. I'm not. Everything I said yesterday was valuable. You might not see the value in it now because you have a myopic perspective. But these levels were given to you yesterday. And the market goes up into it, trades to it, and then rejects it. It takes a whole lot more understanding and a whole lot more complementary understanding with other P&D arrays to do these types of trades, selling right there. And you've watched me do examples of that. It's on Twitter. Go look at it. There's examples of it on my YouTube channel too. Look in the executions, live execution playlist. You'll see it. It's there. But these are the more advanced ones. These are very, very demanding in your understanding. The fair value gap, which many of you are real accustomed to now, you're comfortable with it. What you don't realize is you're doing the same thing here. That high is here. This high is here. The difference is this is a visual aid in telling you how far this part of this run above this old high here, which is this individual candlestick. How far can it go, ICT? Where's too far? Too far is going above this candle's high. That's a stop loss. Entry here. Stop loss here. Now, that's the baseline entry strategy and where stop loss would be. Take it one step further. How can we take this to an amplified, advanced ICT mentorship video? This is a charter level content. This whole stream is a charter level. My charter students are fucking tickled to death right now. They're like, man, this is the shit. Man, we've been waiting since 2016, and here he is out there now doing it. Oh, man. They love it. You should see some of the shit they're saying. What do we have here? What is that? Let me move this out of the way so you can see. What's this part right here? Isn't that a wick? Oh. Well, let's use that information, because that candle is the high end of the fair value gap. Pattern is 3 candles. It's this one. That's candle 1. Here's candle 2 and candle 3. A fair value gap, the inefficiency, is always candle number 2. If it's a down closed candle, it's a sell side imbalance, buy side inefficiency. SIBI, SIBI. If it's a fair value gap that has an up closed candle, it is a buy side imbalance, sell side inefficiency, or a BISI, BISI. Candle number 1. If candle number 1 has a wick right here underneath it, That is a premium array. That means it's it's above the fair value gap, and it's trading up to here. You're thinking, I'm going to get into a trade here or at the midpoint, and you want to see the upper half of that stay open. That's this area right here. Classic fair value gap, where you start, Caleb, when you're studying this, you want to be observing price action, and you don't want to see it trade to this high right here. Okay? In other words, this is what it looks like. This is the framework, so that way you can have screenshots of it. Man, I'm so nice to you. This is stuff I did not want to teach. I did not want to teach it. You're an asshole. You should have wanted to teach this. No, it's too good. And you think you like this stuff. You ought to see the stuff that I'm never going to teach. That makes me... All right, so we're going to do top, right,